After studying this module, you shall be able to know what is meant by monetary transmission mechanism, understand various channels of monetary transmission, appreciate the factors that affect functioning of the interest channel of monetary transmission, learn how monetary transmission occurs through asset price channels, understand what is meant by credit channel of monetary transmission, also learn about various unconventional channels of transmission that were used especially during the recent financial crisis. Monetary transmission is the way by which monetary policy affects the real sector like output. It's an important part of monetary policy through which central bank tries to achieve its objective. Central bank has instruments available to them to achieve their objectives. The most important instrument are short-term rates through which it expects to change the yield curve and achieve objective. But the effectiveness of the instruments also depends upon the underlying economic conditions. We shall see this as we explore various channels of monetary transmission in this module. Now let us discuss about traditional interest rate channel. In the previous module, we have seen that increase in monetary base leads to decrease in nominal interest rate in traditional ISLM framework. The decrease in nominal interest rate leads to decrease in real interest rate provided that prices don't adjust, that is in the short run. That is, as M increases, this leads to a fall in I, which leads to an increase in investment, that is capital I, and which further leads to an increase in income, that is Y. We have also seen that a decrease in real interest rate increases investment as more and more project becomes favorable at lower rate of interest. In traditional Keynesian view, only firms' investment is supposed to be affected by the interest rate, but the later research points out that even the household's durable consumption and housing investments are interest rate sensitive. This leads to increase in aggregate demand and hence increase in aggregate output. There are two important aspects of this transmission. Firstly, that the prices are sticky and thus decrease in nominal rates implies decrease in real interest rates. Second is the movement of the yield curve. The investment decision of firm and consumption and investment decision of the household are dependent on long-term rates. Based on the expectation hypothesis, the long-term rate is average of short-term rates, and so if the short-term real rates decrease, this implies the long-term real rates also decline. The pass-through from short-term rates to long-term lending rates are very important for this transmission channel to be effective. In Indian case, it has been argued that banks don't decrease the lending rate when the central bank reduces the short-term rate. The reason being that banks' cost of funding doesn't decrease as large parts of the deposits of the banks are long-term deposits. There is substantial variation in financial development across developing countries, and three common features of developing countries have been noted. The first is an underdeveloped bond market. A well-developed bond market is very important for smooth functioning of the interest rate transmission discussed earlier. The pass-through from short-term rates to long-term rates is generally weak in case of developing countries, thus weakening the interest rate transmission. This pass-through is important for monetary transmission as it's the long-term rates that matters for real economic activity like investments. The second feature pertains to the banking system. There is little competition in the banking sector and frequent reliance on deficit financing by the government leads to resource preemption. The pass-through from policy rates to deposit rates and lending rates is found to be weak. In case of India, it is often observed that rate cuts by the RBI are not passed on by banks and stickiness of deposit rates is very common. Further, high cost of information processing, evaluating projects, and monitoring borrowers induce banks to maintain persistently high levels of bank reserves. Third, there is a large informal sector for lending in most developing countries. The size of this sector and the nature of its linkages with the formal financial system has important consequences for monetary policy transmission. When the central bank raises rates, the monetary policy transmission tends to be weak because this does not directly affect informal finance. This kind informal lending may weaken the traditional interest rate channel in case of developing economies. Then there are other asset price channels. Number one, the exchange rate channel. This channel of transmission works as follows. M increases, which leads to a fall in small I, that is interest rate, which leads to an increase in exchange rate, which leads to an increase in N into X, which further leads to an increase in Y. Increase in monetary base leads to decrease in nominal interest rate in traditional ISLM framework. This decrease in interest rate makes the domestic deposit less favorable in comparison to foreign deposits. Supply of the domestic currency increases as they try to go and deposit in the foreign countries, and this leads to depreciation of exchange rate, that is ER. Even with capital controls applicable for domestic citizens, this will lead to depreciation of exchange rate, as decreasing interest rate will lead to decline in demand of the domestic currency by foreigners. The depreciation of exchange rate will lead to an increase in net exports, that is N into X. As exports increase and imports decreases, this will increase the output, that is Y. Depreciation also makes import costlier in terms of domestic currency and may raise the domestic price level. This is called exchange rate pass-through. In a country like India, which is gradually being more interlinked to global economy and largely dependent on imported oil for its energy needs, exchange rate plays a key role in determination of macroeconomic variables like inflation. For example, depreciation of the exchange rate would lead to higher oil prices in terms of domestic currency. These factors make exchange rate transmission important for developing countries. The Indian economy is also dependent on imported oil. Further, with economic reforms, the economy has become interlinked with the global economy. Over the last 20 years, it has changed from an inward-looking to a much more outward-oriented one. Therefore, in case of India, we expect exchange rate channel to be an important channel of monetary transmission. The second channel is equity or asset price channel. This works in this way. M increases, leading to a fall in small I, leading to an increase in EP, leading to increase in Q, which further leads to an increase in capital I, that is investment, which leads to an increase in Y. James Tobin's established the idea of Tobin's Q. It is defined as market value or replacement value of capital stock. Market value of capital stock, that is EP, is net present value of the stream of dividends. Increase in monetary base leads to decrease in nominal interest, and this leads to an increase in the market value of the capital stock. Firms find making investments by issuing equity beneficial, and thus it increases investments. Increase in investment implies higher Y. The third channel is wealth channel, which works in this way. M increases, leading to a fall in I, leading to an increase in EP, leading to increase in W, further increase in C, and then an increase in Y. The alternative channel of monetary transmission dependent on equity prices, that is EP, arises through households. In Mojigilani's life cycle model, the household consumption decisions are dependent on lifetime resources of the household, that is W. Lifetime resources of household comprise of human capital, real wealth and financial wealth. Increase in monetary base leads to decrease in nominal interest rate, and this increases equity prices as described above. Increase in equity prices increases the lifetime resources of household, and this increases consumption. Increase in consumption leads to increase in income, or Y. The Tobin skew can be easily extended in case of housing on land prices, that is HP over LP. The value of housing and land can be modeled as the discounted present value of rent received from it. Increase in monetary base leads to decrease in nominal interest, and this increases housing and land prices. Since house and land, that is real wealth, are important components of lifetime resources, this increases wealth, or W, and increase in wealth leads to higher consumption. Higher consumption leads to higher income, that is M increases, which leads to a fall in rate of interest, which leads to an increase in housing prices and land prices, that is increase in wealth, increase in consumption, which further leads to an increase in income. The fifth channel is credit channel. There are several credit channels. The number one is bank lending channel. Consider a bank's balance sheet given here. The liabilities, capital, deposits, and the borrowings. And then there are assets, loan, investments, and cash. Consider a bank balance sheet given here. The cash has two components, one as required by the regulator, as in case of India, known as CRR or cash reserve ratio, and the second cash for day-to-day business requirements. Increase in monetary base happens either through reduction of CRR or buyback of securities. This increases the cash with banks. Bank optimizes their portfolio and increases bank loans. Increase in bank loans translates into higher investments, and this increases income. In this case, M increases, leading to an increase in bank deposits, an increase in cash, then an increase in bank loans, which leads to an increase in I, and which further results into increase in Y. In the opposite case, with the decrease in monetary base happens either through increase in CRR or sale of securities. This decreases the cash with the banks. Bank optimizes their portfolio and may decrease bank loans. Decrease in bank loans translates into lower investments, and this decreases Y. There are three important aspects of this channel to be effective. Firstly, there may be a situation in which increase in cash doesn't increase the loans, as banks are reluctant to lend. Banks may be reluctant to lend if the economic conditions are depressed, and lending may be risky. After the financial crisis of 2008, US Federal Reserve increased the cash holdings of the banks by buying securities, as they were expecting that banks would increase their lending. But banks held these cash with themselves instead of lending. Second, banks must not be able to substitute the reduction in cash by arranging cash from some other means. McClung argues that since the central bank is always ready to lend cash to the banks, this may reduce the effectiveness of bank lending channel. Third, the lending channel to be effective, there must be some borrowers who are completely bank dependent, and reduction in bank loans leads to reduced borrowings by them, meaning that they can't get required capital by other means. Thus, the lending view hinges on the failure of the Modigliani-Miller or MM proposition for banks as well as the borrowers. Modigliani-Miller or MM proposes that capital structure is irrelevant and funding patterns are immaterial for the companies. Especially households and small firms lack access to form of credit other than bank loans. In countries like India, this channel could be of great importance as borrowers are mostly bank dependent due to not so developed financial market. The second is balance sheet channel. Borrower's net worth is important consideration for a lender. Higher net worth reduces adverse selection and moral hazards problems, whereas lower net worth increases adverse selection and moral hazard problems. Borrowers with less net worth are expected to involve themselves with more risky ventures, thus aggravating the moral hazard problems. Monetary policy affects the borrower's net worth or NW, balance sheet component, and thus problems of adverse selection, that is AS, and moral hazard MH in lending. Monetary easing increases equity prices or EP as described above and thus increases the net worth, that is NW. This in turn decreases adverse selection and moral hazard and leads to increase in lending. Increase in lending leads to higher investments and higher income, that is Y. That is, we can say M increases, this leads to a fall in small I, leading to an increase in EP, leading to an increase in NW, which further reduces AS and MH, leading to an increase in bank loans, an increase in investment and increase in income. Monetary easing lowers the nominal interest rate and thus lowers the interest payment by the firm and thus increases their free cash flow. Higher free cash flows reduce adverse selection and moral hazard problems, and this in turn increases in bank loans, investment and higher income. This channel is different from the traditional interest rate channel in two ways. First, it's not dependent on the stickiness of price, and second, the movement across the yield curve is not required for the same. An increase in M leads to a fall in I, leading to an increase in free cash flow, leading to a fall in AS and MH, an increase in bank loans, which leads to an increase in I and an increase in Y. A related channel can rise because of credit rationing. Credit rationing is a situation in which borrower is denied a loan although he is willing to pay higher interest rates. Banks, having a profit maximization approach, denies loans to those who are willing to pay higher interest rate, assuming that they are going to take more risky ventures. With low interest rates, the fraction of people who are going to take less risky ventures increases, and thus banks find it more comfortable to increase their lending. Increase in bank lending is followed by higher investments and higher income. Another related channel could arise from the debt structure. Since the debts are normally fixed in nominal terms, an unanticipated rise in prices reduces the real value of debt. This in effect transfers the wealth from creditors to the debtors, and thus it increases the net worth of the borrowers. Increase in net worth implies increased bank lending, higher investments and higher income. This channel becomes very prominent during the economic downturns, in which unanticipated decrease in price increases the real burden of the debt, decreases net worth and thus increases bank lending, lowers investments and lower income. The increase in real burden of debt lead to deleveraging, a process in which the borrowers pay down the debt to improve debt equity ratio. This leads to reduced consumption and investments, contraction of economic activity. The third one is household balance sheet. This works as under: M increases, leading to a fall in I, leading to increase in EP, an increase in NW, which leads to a fall in FD, which leads to an increase in DC and HI, which leads to an increase in income or Y. Household net worth is important consideration for their durable consumption, that is DC, and housing investment decisions, that is HI. Higher net worth reduces chances of financial distress, whereas lower net worth increases. Monetary easing increases equity prices or EP as described above, and thus increases the net worth or NW of the households. This in turn reduces the chance of financial distress and increases housing investments and durable consumption. This leads to higher income, that is Y. Debt deleveraging, as explained above, is also possible in the case of households, leading to reduced consumption, durable consumption and housing investments and thus contraction of economic activity. This channel was quite prominent in the aftermath of 2008 financial crisis. Households who have borrowed for homes due to unanticipated fall in housing prices, suddenly found that they are over debt and started deleveraging, and that reduced consumption and leads to lower income. Coming to some other channels. The first one is expectation channel. This channel becomes important when the nominal interest rate touches zero lower bound or ZLB. In case of ZLB, the central bank can't lower nominal short-term rates anymore to affect long-term rate, investment and income. But central bank can influence the expectation of people by monetary easing, as people will perceive the monetary easing as a reason for future inflation, that is PE. This reduces the real long-term rates, that is R, if the nominal rates don't rise, and thus spur investment and increases income. That is, an increase in M leads to an increase in PE, which leads to a fall in R, which leads to an increase in investment. In the aftermath of the recent financial crisis, when the federal funds rate touched ZLB, the Federal Reserve Bank resorted to this channel. Another important benefit of this channel is that it keeps away the deflationary pressure and thus protects the debtors from increased burden of the debt. The second one is bank capita channel. Banks have to maintain a certain percent of equity as a proportion of assets, that is CRAR. In the case of monetary easing, if the banks find that it has not sufficient capital to fund the risky loans, it may hold the extra cash on its balance sheet or will invest those cash into risk-free assets like treasury securities. This will not bring the intended increase in the bank lending. In the aftermath of the recent financial crisis, when the capital was fast depleting for the banks because of bad debts, banks couldn't lend the extra cash on their books as they faced shortage of capital also. The third is duration risk channel. This and the following channels discussed below are unconventional channels of monetary transmission. A theoretical one-factor model produces a risk premium on a bond of maturity T, that is approximately the product of the duration of a maturity T bond and the price of the duration risk, which in turn is a function of the amount of duration risk borne by the marginal bond market investor and this investor's risk aversion. Central banks can reduce the supply of the long-term bonds by buying them in the market. This significantly reduces the duration risk of the investors and thus reduces the yield of long-term bonds in comparison to the short-term bonds. This can be accomplished by operation twist, basically changing the maturity composition of government bond held by public in a manner to affect yield in desired direction. Federal Reserve Bank did it in 1961 to flatten the yield curve by selling the short-term bonds and using the proceeds to buy the long-term bonds. This works even when the short-term rates touches the ZLB. Federal Reserve Bank used it again in the aftermath of the financial crisis in 2011 under the widely popular quantitative easing, that is QE. RBI faced a very tough situation the second half of 2013, where it faced a depreciating rupee and declining growth. Rupee was depreciating because of the capital flight. The obvious response would have been increase in short-term rates, but RBI can't afford these higher short-term rates being propagated to higher long-term rates, as it will hamper the growth. RBI started selling short-term treasury bills, thus making the prices of treasury bills lower and increasing the yield on that. At the same time, bought long-term government bonds using the proceeds obtained from selling treasury bills, thus increasing their price and decreasing yield on that to support growth. The fourth channel is liquidity channel. Most financial assets pricing have a liquidity premium associated with them. Higher the liquidity premium, higher the yield would be. Central banks, through buying of long-term bonds, can decrease the liquidity premium on those bonds and thus lower the yield on them. This gives rise to Liquidity Channel. Federal Reserve Bank, in aftermath of the financial crisis 2008, used this channel to affect the long-term rates by buying them, thus reducing the liquidity premium on the long-term bonds. This channel is effective in the aftermath of the financial crisis as liquidity premium rise because of the liquidity crunch. The fifth channel is signaling channel. Central bank can lower the interest rates by signaling the commitment to keep short-term rates lower in the future. Long-term rates are average of the expected short-term rates, and thus if central bank is able to signal that it will keep the future short-term rates lower than what's expected, it may be able to lower the long-term rates. Two important aspects of this channel to work are communication and the credibility of the central bank. Central bank must communicate its desire to public, and central bank must be credible enough so that people can believe the central bank. There is always an issue of time inconsistency, as people may think that central bank will not keep its words and will raise the rates in the future. The sixth is safety premium channel. There is evidence to indicate that there are significant clienteles for long-term safe, that is near zero default risk assets, that lower the yields on such assets. Pension funds are one of the examples. Due to safety premium, the yields on these safer long-term bonds are lower than the comparable less safe bonds. When the central banks buy safe long-term bonds and decrease the supply of safe bonds, the safety premium increases on bonds, lowering their yield further. The evidence comes from relating the spread between BAA bonds and AAA bonds or agency bonds to variation in the supply of long-term treasuries over a period from 1925 to 2008. They report that when there are less long-term treasuries, so that there are less long-term safe assets to meet clientele demands, the spread between BAA and AAA bonds rises. The seventh is default risk channel. Lower grade bonds such as BAA bonds carry higher default risk than treasury bonds. If the central banks buy low rated bonds, it certainly affects the quantity of such default risk as well as the price, that is the risk premium of the default risk. This implied lower long-term rates. Federal Reserve, in the aftermath of the recent financial crisis, bought different type of non-treasury securities to reduce the default premium associated with them. Now let us summarize what we have learned from this module. In this module, we have discussed various channels of monetary transmission. The dominant channel of monetary transmission differ across countries and are dependent on the structural characteristics of the countries. The predominant channel in developed countries is the interest rate channel. In developing countries, we expect credit channel and exchange rate channel to be more important. Even in the developed countries where interest rate transmission is important, the effect works out through different factors. In case of US, interest rate transmission happens mostly through consumption, whereas in Japan, it happens mostly through investment.